welcome to our fourth episode in our series. And in this episode, we'll talk about um, the higher time frame and the lower time frame structures, which can also be known as the external and the internal structures. We'll lightly talk about trend lines and the Fibonacci retracement too. Okay, let's begin with the structures. This is TradingView, right? And TradingView gives you the advantage of viewing the market from several periods of time. And currently, we are looking at the gold market from the yearly perspective. As you can see, the market's record of the market has been since 1833 up until current time 2026. And there was little to no motion in the market up until somewhere between 1934 and then proper motion around 1974. Okay, and then since then you can identify that the market has been moving with certain trades, and I expect you to know what kind of market we are looking at, because we said earlier that the market exists in one of three patterns at all times. So looking at this market, I expect you to know, based on the behavior and the characters of the market, what kind of market we are looking at. So obviously we are looking at a bullish market because it has higher highs and higher lows. Okay, and this is the market from a higher time frame. Okay, let's go to a relatively lower time frame. You can view the market from a monthly perspective, which in which case it still remains bullish, and you can look at the market from a weekly perspective, and you can go as low as even to a minute. Okay, and so in this segment we will talk about the structures involved in the higher and the lower time frame structure. The higher and the lower time frame. Okay, let's take this for example. We are going to consider um, we are going to consider um, the higher time frame structure. Okay, give me a second. Let's look at this. This is a higher time frame structure where the market is creating higher highs and higher lows. Okay, let's consider this. In this market, say this is happening on the weekly, or yes, on the weekly time frame. Okay, you obviously see a break of structure over here, and I hope you remember our lessons on break of structures. You can see that the market broke structures to the upside, and so we are clearly seeing a bullish market. Okay, with the and we know this is an impulse and this is a correction. Okay, so this is what is actually happening with the impulses and the corrections. Okay, when you break it down, what you're actually going to see is movements like this. You're going to see movements like this on the lower time frames or internal structures. Okay, because we said the market never actually moves in a straight line, it moves in a zigzag pattern. And so when you are looking at a market on the higher time frame, what should you know is on the lower time frame the market is doing something like this, and so on and so forth. Okay, so let's consider this movement. So this is a higher time frame structure, the structure in blue, and on the lower time frame structure, what you observe is we have mini structures forming. We have a bullish trend over here. You can tell that because there are break of structures and there are higher highs and higher lows and break of structures to the upside until we got to this point where the impulsive move of the market. Once again, the impulsive move is the move that goes in the direction of the main trend, and then the corrective move is the counter trend movement, where the market seeks to take a breather before creating the next wave. Yes, that will ultimately break the previous structure. Okay, so what you notice is that the market was creating a bullish character, a bullish trend to the upside, and then when we finally got to the point where the corrective move, where the market had found resistance, you will observe that in this internal structure, the market was making higher highs and higher lows, and then higher highs, and then it made a lower low, taking out this specific low on the internal structure, ultimately creating a change of character on the internal structure. And the change of character is confirmed when you realize the market prints a lower high, and after that the market changes character and starts behaving in a bearish trend formation. And once the market has reached a point of support, when the market finally found support in this region, what the market did was a change of character once again, printing a lower low, then it goes to make a lower high, then it fails to make a lower low, printing a higher low, and then a change of character where this previous high becomes a higher high, taking out this one right here, okay? And you identify a change of character. So what we are basically trying to say is that on the external time frame, the movement you see on the external time frames constitutes a lot of movement on the internal time frame, okay? And the internal time frame ultimately gives character, or it gives context, it gives you details of what is really happening on the external time frame. Let's consider the charts. Let's consider this movement, this price action right here, okay? What you'd observe is that price had printed a higher high over here, and then it printed a higher low, okay? And then at this point in time, price had taken out this previous higher high print, and it printed once again a higher low, and then this higher high was taken out at this point, and then a higher low was printed. And price got to this point where it printed a higher high. However, after the price had done that, what you notice is that the price dropped to this point, taking out this previous higher low we have marked out, signaling a change of character, okay? And once that has happened, you keep an eye out, and then just to be sure that the market has actually changed the character. And if it has changed the character, we expect to see characters of a different kind of market. And indeed, you identify that the market starts to create lower highs at this point and lower lows, and then it creates a lower high, creates a lower low, okay? And so you are sure that the market has indeed changed its character, and we are no longer looking at a bearish market, we are now looking at a bullish market, okay? Let's consider this movement. If you, without going down into lower time frames, you'd be able to identify many structures forming over here. When the market was attempting to take out this previous high, the market creates it forms a higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then it just keeps moving in that pattern. And so obviously when you break it down to the smaller time frame, you will see the structures a little more clearly, okay? But for a better example, consider this movement to the downside to make more sense of our lesson. Okay, so let's break it down to a relatively lower time frame. Okay, so on the 4 hour time frame, what you notice is that what we marked out on the on the external structure or on the higher time frame as an impulse, because this was the move that changed the character, and then we said that a move in the direction of the trend is what we consider an impulse, and then the move in the counter that counters the direction is what we call a correction, okay, or a retracement or a pullback. So this is the impulsive move that change the character, and then this would then be the correction, okay? This right here up until the market found resistance, and then it was at the point of interest, and then it created the next impulsive wave, okay? So let's consider this movement here. What would look like a bullish movement to most people will be clear on the external structure as a corrective move, okay? This, to most people, a lot of traders might just think, having seen this drop to the downside, and after that, considering that the market moved in this fashion, creating a higher high, higher low, a higher high, a higher low, a higher high, a higher low, and then a higher high. A lot of traders would consider this movement to be bullish and might even expect the market to come all the way to the upside, finally taking out this previous high. And then once that is done, then you are confirmed that we are still moving bullish, right? Because in a bullish trend, we want to see break of structures to the upside. However, since we marked out on the higher time frame that there has been a change of character with a break of this low to the downside, we are now suspicious because we have identified a change of character, and so we are sure that, or we are looking out for a bearish market now. Okay, and then the internal structures is what is going to give you a little more detail or confirm our theory. Okay, so on the 4 hour, right, well, let's just begin by marking out the higher highs and higher lows. Okay, so on the lower time frame, we identified that this was the lower low the market had printed to begin with. Okay, this was the lowest low the market had printed, and right after that, the market prints a higher high. Okay, or a lower high when we are considering the bigger trend. However, in this case, we are considering the smaller trend. So on an even smaller time frame, you would notice that the market printed a lower high over here, and then it printed a higher low because this failed to take out this, and then we would see this movement to the upside. And so we consider this right here higher high. Okay, and then after that, just as we suspected, the market prints out a higher low, and right after that, sorry, right after that, the market prints out another higher high. We notice the market print out um, a lower low once again, and after that, the market prints out. Oh, forgive my tools. The market prints out a higher high once again. And after this higher high has been printed, the market prints out a higher low at this region over here. Okay, and so for everybody who is not sure, we just know that okay, after this specific movement to the downside, this impulsive movement to the downside, we might be looking at a correction, or this movement itself could just be a deeper correction, and then we might just see a trend continuation to the upside when this high is finally broken out of, and then we'll see a break of structure to the upside. However, so we are keeping a lookout on this specific trend, okay, to determine if indeed it's a correction or an impulsive move. Okay, so let's consider this. We noticed the market was moving in a bullish pattern until it finally got to this point where it had printed a higher high. Okay, and just like it was doing previously, we kind of expect the market to print out higher highs and higher lows and higher highs and higher lows. However, after the market had printed this movement to the upside, what we notice is that this region where the market had printed a previous higher low was sticking out. Okay, and so you can identify a change of character in this region right here where the market finally took it out, and then it printed a lower low. Okay, and at this point this should have you a little suspicious and have you wondering, what is the market trying to do? Because are we looking at a change of character on the internal structures as well? And then this theory will be confirmed when you identify the market printout an even lower high. Okay, because this high is not as high as this, and it doesn't take this out, creating a break of structure to the upside. And then if you are not even convinced at this point, what you observe is that this low region was finally broken out of at this point, creating a break of structure to the downside. Okay, and so that is your confirmation that, well, we were probably looking at an impulsive move, since the bullish movement has failed to continue, and the bearish movement is in play. And so this bearish movement, if this is a corrective move, then we might just be looking at an impulsive move to the downside, since we are considering a bearish trend. And just like that, rightfully so, you see a bearish movement, an impulsive movement to the downside, and then we are sure that okay, this indeed was a bearish market. Okay, so that is how to put the lower time frame and the external time frame into perspective, how you put them together. The external time frame is supposed to give you the bigger structure, and then the lower time frame is supposed to give you details on what is happening and give you perspective, okay, and context, okay. And as you can see, after this impulsive move to the downside, when the market drops like this, and this impulsive move itself is constituted um, lower highs and lower lows, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, okay, until the market got to a point of support right in this region, okay. The market hit support in this region, and right after that, what did we say? When the market finds support, you'll probably take a breather, put yourself together, gather enough momentum to take out the support. And so after the market had found support, the breather is what we usually call the retracement or the correction, okay? And in the correction is the counter trend direction. And since this trend is bearish, the counter trend direction will be bullish. So what you identify is like we did in the first illustration where we drew a external structure and then we drew mini trends within the external structure. You identify the market start to create a change of character to the upside. Then the market starts to form higher highs, higher lows, higher highs, higher lows, until we finally see a change of character when the market printed this lows and this highs and it took it out, creating a higher low. I mean a lower low. And if this low is not convincing for you, you finally identify the market, take out this low over here and this movement here, and then you see it print again. You see it print again a lower high, okay, before continuing to the downside. So internal structures give context or they give character to the external structures, okay. They let you know what is happening on the bigger time frame, but you need the bigger time frame to understand the general trend, and so that you don't get your corrections and your impulses confused, and then you use the internal structure for more color and more details, okay. I hope this little illustration clarifies it and makes it a little bit consumable, okay. Let's quickly consider trend lines and the Fibonacci retracement tool, okay. So what are trend lines? Okay, I define trend lines as guidelines, okay. A trend line is a guideline that lets you know the performance of a trend, okay. It's a guideline that lets you identify or it gives you more details on the performance on a specific trend. I'll give you an example. In this specific movement here, from this point to this point, we identify that it's obvious that the market's character is that of a bearish one, and so we are looking at a bearish market, okay. And so to identify how well this bearish movement or this bearish trend is performing, we are going to use the trend line tool. And how we are going to do that is we select our trend line tool from our list of tools TradingView gives us. And if you are not sure, it's on your left side and it's in the second toolbox, okay. And let me just state that most people love to draw their trend line using the ray tool, okay, but we are going to be using the trend line tool in this lesson. So to mark out your trend line tools, and mind you, you can consider a bullish trend and a bearish trend and how they are performing, okay. So we are going to see the performance on a bearish movement. To mark out the trend line for a bearish movement, what we are going to do is we are going to select the two most relevant, because we are looking at the bearish movement, we'll consider the most relevant high points, okay, the lower highs that the market has created, okay. Because the lower highs is where the market gathers enough momentum to create the next impulse, okay. So we'll consider this first movement here and we'll consider the next movement where the market printed this lower high, because this lower high created this impulsive move that ultimately caused a break of structure to the downside, okay. So and we'll draw our trend line tool this way, okay. And the trend line tool what the trend line tool tells us is that this is our area of support, okay. of resistance. Okay, and so because of um this movement from this point here and this movement from this point here, you expect that this vertical line will be our resistance. Okay, and then we would like to see that every time the market gets to this point, we expect it to fall, ultimately creating a lower high. We do not expect the market to break out of this, because if the market does break out of this structure, what we would see is what we observe is that uh, give me a second. um, if the market should behave in this pattern, what you would observe is that it takes out a lot of internal structures, and we might just as well be looking at a change of character from the internal perspective, and we could definitely see um, a movement to the upside. Yeah, and so we'll definitely be able to see a change of character to the upside, and it's very probable because, mind you, the internal structures constitute the external structure. Okay, so what we expect to see is the market respect this trend line and keep moving bearish. And so every time the market breaks out the trend line, start considering the internal structures. Okay, and see what is happening for a little more clarity, because you might just be looking at a change of character. And it's important to state that the trend line doesn't have to stay like this. Okay, you can break your market down to several time frame, because as we know, different traders trade on different time frames. Okay, and so you can change your you can draw your trend line on a lower time frame, and all you have to do is just connect the two recent high points. Okay, for a bearish market, just connect the two recent high points like this and that. We are not going to use this because the market has already intersected this market, has already broken out of this trend line, and so this is the most recent and relevant high point. And so we'll find a touch on that region, and we'll extend our trend line into the future. Then we expect that in the course of the market performance and movement, we'd like to see the market have a specific kind of reaction when it has to touch the trend line. We like to see it touch the trend line and bounce lower. If the market should break the trend line, then obviously you can identify there will be a change of character in the internal structures, and that might be signaling a different movement. Okay, and you might see the market do something else. Okay, so you can draw trend lines on several time frames. While we are on the lower time frame, let's consider a trend line movement on a bullish market. Sorry, so let's consider this bullish movement to the upside. Okay, just to see the performance of this specific bullish trend. um, this one for a while. So we are connecting the low, the higher low at this region to the next higher low, the most relevant. And obviously, we can't use this because you see how it goes. So you are connecting to the most relevant one, okay? And then as you can see, there was a touch on this point over here. The market gave it a first touch, it then gave it a second touch, and then it gave it a third touch in this region. And unfortunately, we expected the market to keep touching on it and break structures to the upside. But when the market finally broke out of it, it signaled a change of character where the market did something else. And as you can see, the market had a bearish performance. Okay, and then you can just keep, you know, putting trend lines together. Okay, just consider the most relevant points, and the market would give you an idea of the performance of a specific trend you are looking at. Okay, so that is how trend line works. They give you an idea of the performance of a specific trend. Okay, now let's consider the Fibonacci retracement. Okay, I'm going to consider the Fibonacci retracement. And just like the name implies, the Fibonacci retracement tool is a tool that helps you calculate the performance of a retracement. Okay, and then we said earlier that a retracement is another name um, um, for a correction or a pullback. Okay, so let's calculate the retracement for this specific impulsive move to the downside. Okay, and retracements are ultimately calculated on impulsive moves, because after an impulsive move is when you see a correction, okay, or a retracement. Okay, so we will calculate the retracement of this impulsive move to the downside. And so to mark out your fib for the impulsive move, since this is a bearish move we are calculating, we are going to start from the point the impulse move started from. Okay, and in this case it was this higher high right here to this lower low. And so you mark out your you identify your first high point and you click on it and you drag your fib tool all the way to the low point, and then you plot down there as well. And so what the fib tool will do is give you the percentage or the range of this movement. Let's say this movement right here is 200 points. Okay, let's say the market was at 200 at this point and then it dropped, sorry, 100 points. Let's consider this a 100-point movement. So the market dropped 100 points all the way to the downside. So with this specific impulsive move to the downside, the market price was no longer 200, it is now 100 at this point. Okay, and you start to see a retracement. This is the 23% region, 38%, and the 50%, and the 61% region. Okay, other charts might have the Fibonacci tool looking a little different with a little more details. You might see the 70% and so on and so forth, but basically they just give you the percentage of the retracement. So if the market should get to this point in the course of the retracement, like when price gets to this region, then price has come back 20%, and so instead of the market being at 100, the market will currently be at 123. If it makes it to this region, the market is currently at 133, and if it makes it to this region, the market is currently at 150, half the price of this entire movement. And if it does make it this point, the market is at 161. Okay, and so sellers might look to get involved here because they'll consider that the price was at 200 and it came all the way to 100. Okay, so the market might be looking to be bearish. Okay, and so I missed out on this move here when the price came all the way from 200 to 100. Okay, but I've noticed the price has gone higher to 120, 130, 150, and it's at 160, probably 170 or 80. And you say, okay, well, this is quite expensive. Okay, since I couldn't sell it at 200, the next best time to sell is at 180, because 180 and 100, 200 is not too bad. And so they will get involved at this region and sell the market up until it gets to 100 again or even lower, looking to make some profit. Okay, and that's the concept of a Fibonacci movement. Let's consider this on a bullish uh, movement. Okay, let's consider this impulsive move to the upside. And so with the bullish movement, you plot out the Fibonacci the same way, but the opposite. You consider the lowest point that started the impulsive move, and you drag your two and plot it out at the highest point the market got to. Okay, and in that the market will once again give you all the regions of the movement. So this will be the 20% of it, this will be the 30%, this will be the 50%, and the 60%, and so on and so forth. Okay, so if the market drops to this point, yes, the market has lost 20 points of the movements it made. If it comes here, it has lost 30 points, 50 points, and this entire movement, this region is half of it. Okay, this is 50% of the move to the downside, and this is 50% to the upside. This is the 61.8 region. Okay, so the Fibonacci tool helps you identify the performance of a retracement, and there are indeed some relevant points in the Fibonacci tool, and we'll be using that in our next lesson. And yeah, so in our next lesson we'll go into a little more details on the Fibonacci tool, and probably in a different lesson we'll talk even more about the Fibonacci tool and the trend line tool. Okay, so I hope this lesson is well understood. I'll see you in the next one.